Time now for a very special interview with New York Fed President John Williams. For that, we want to head over to Steve Liesman. Mr. Liesman.
Andrew, thanks very much. I am here at the New York Federal Reserve Bank with New York Fed President John Williams. And I want to make a note to viewers that obviously there's a lot of things happening with the Federal Reserve. These things are scheduled pretty well in advance. So, John, thanks for joining us.
Steve, welcome back to the New York Fed.
Yes, it's always great to be in these incredible hallways here. Let me begin with the news of the day, which is that the president, for the first time in history, has fired a governor of the Federal Reserve Board for cause. I want your reaction to the president's actions and your reaction to the allegations against Fed Governor Lisa Cook.
Well, I don't have anything to add or say around and the allegations. Obviously, that's a legal process. I'll let others speak to that. Personally, I have worked with Lisa Cook as she's been a member of the Board of Governors, and she's always brought, integrity and a commitment to the Federal Reserve's mission. She's a very esteemed and highly respected economist. But I think the broader picture, obviously, is that, I think Federal Reserve central bank independence is very much very important. It's important not because it's convenient or anything like that, but because we know from history, from experience, that independent central banks can deliver low inflation, economic and financial stability. And we know the structure of the Federal Reserve is such that it's designed to have independent policymakers who are making decisions that affect the economy over the longer term, away from short-term political pressure. And I think that's really, really important.
But if the president can fire somebody based upon allegations, does that threaten the Fed's independence?
Well, again, I'm going to just speak to the importance of the independence and something that, I think is proven to be valuable around the world. We see countries throughout all the continents really have turned to having independent central banks like we do, so that you can get the best outcomes for the people of the country and in our case, for the United States and quite honestly, for the world. The Federal Reserve is obviously very central to the health of the U.S. economy and the global economy.
So one more question on this topic. There's this one issue that seems to come up, which is the issue of Fed independence and the president perhaps threatening that with these by firing Federal Reserve Board of Governors. On the other hand, there are the charges. The idea that the Fed Governor Lisa Cook might indeed have committed mortgage fraud. How serious is that?
Well, again, on these accusations, I don't have anything to say to that or add to that. I think really that's a process that's underway and should talk to the people involved in that.
Move on now, John, to your outlook for the economy. GDP has slowed. Payroll growth has slowed. How much concern do you have that the economy is weakening or softening here?
Well, it's absolutely true. GDP growth has slowed in the first half of the year, roughly 1.25% growth at an annual rate relative to about 2.5% last year. My expectation is that's going to continue through this year, but that's a slowing economy. It's not a stalling economy. We look at a broad set of indicators. I think we're seeing kind of an economy going through an adjustment process, partly the continuing adjustment from post-pandemic, partly an adjustment to some of the policy changes that have happened, including trade policy. So I see that as something that's been ongoing. I'm watching very carefully, watching all the indicators in the labor market, spending. So my view is the economy is growing, will continue to grow. For the year as a whole, maybe 1 to 1.5% annual rate, a little bit, like I said, a little bit slower than last year, but still positive momentum going forward. But I'm watching that data very carefully.
You had described the job market as solid, but we've also had, and this was after the big revisions, how do you make that claim if we're just doing, I don't know, on average 35,000 jobs a month?
Well, there's two different, you're asking kind of two different questions. So let me go to both of them. First of all, when I say that the labor market is solid, which I think it still is, I'm looking at the state of the labor market. The unemployment rate, which is 4.2%, which is historically very low number. You look at other indicators of labor market strength, including from surveys of households, surveys of businesses, how easy is it to find a job, how hard is it to hire people. Those are also in I think in a solid labor market, and other indicators like quits and higher rates and things like that. So I think the state of the labor market is solid. We've definitely seen a slowdown in the pace of hiring in payroll growth, as you mentioned. I think some of that is really a slowdown in the supply of labor. As we all know, the labor force is growing more slowly now because of slower immigration, much slower immigration. So we're seeing slower supply and slower demand. And the hard thing to do is to figure out, well, is one slowing more than the other? The test of that is kind of the unemployment rate. The unemployment rate's been pretty steady, low fours, hasn't really changed over the last 12 months. Other indicators, I think, have, I would say, gently softened over the past year, but again, still a solid labor market.
Do you have a number or a range in your head of what the break-even rate is for it? In other words, how many jobs do we have to add each month in order to keep that unemployment rate steady?
Well, that's really hard to determine. I mean, there's a lot of estimates out there. In kind of more normal times, people talk, say, before the pandemic, maybe 100,000, 130,000 or something. Because of the changes in labor supply, that makes it very hard to know. When we had strong immigration a year or two ago, then we saw the break-evens clearly be much higher than usual. Now they're much lower. I don't have a good estimate. I think here is one of those times you have to, really show humility about the ability to understand what's happening exactly with labor supply. We don't have great real-time estimates of immigration flows. So I, again, look at these other indicators like the unemployment rate and others that are telling me kind of how that balance is looking. The final thing I'd like to say is, wage growth is a good indicator of the health of the labor market. Wage growth continues to be, I would say, consistent with a solid labor market and inflation coming down towards our 2% goal.
So this is important. You're saying you would not sort of push the panic button on the jobs market if you had even running lower payroll numbers, if the unemployment rate, wage growth, and other ratios suggested there was still health in the labor market.
Absolutely. Now, that's absolutely right. I do, I have studied, previous downturns, and if payroll growth, became very negative or turned kind of convincingly negative, I think that's telling you something different. But that's why you also look at other measures like initial claims for unemployment insurance, which are also very low. And there are other indicators that maybe are better signs of maybe a turning point in the economy.
Let's talk about the other side of the mandate, inflation. There was some concern among some of your colleagues, Austin Goolsbee comes to mind, that the recent inflation numbers were not limited to just tariff issues. What do you see when you see the inflation numbers, and how concerned are you that they're moving incrementally and slowly, but away from target?
I think the underlying inflation, if to the best you can, set aside the direct effects of tariffs, we have seen inflation come down gradually over the last few years. It's very gradual now, and it's hard to do this kind of, in a way, separation of effects of tariffs from other dynamics. We have seen a slowing of housing costs and inflation. Where we've not seen the slowing recently is kind of the services excluding housing. So I'm watching that data carefully. If you look at the data, we're going to get the new numbers later or soon, but the estimates are that core PC inflation will probably come in around 2.9% based on what we know from CPI and PPI. So I would say that maybe you're getting 4 or 5 tenths of that from tariffs. The rest of it is still above our 2% goal. It's been coming down, but it's coming down pretty slowly.
So the market thinks you will be cutting rates, and many of your colleagues do as well. The chair seemed to suggest that was on the way. Are you on board with a rate cut?
Well, in my view, if the economy evolves the way I hope it will, and that means that inflation, after adjusting for the tariffs, inflation comes down over the next couple years, the economy stays in relatively good balance. I do think at some point we need to move interest rates closer to normal or a neutral stance. We are still in I would say, modestly restrictive stance. I think the evidence shows that the economy is gradually slowing. As we talked about, inflation is gradually coming down. And so if things move in the way that I hope they do in terms of our maximum employment and price stability goals, then I do think it will be appropriate to move interest rates down over time. But we got to be driven by the data. We got to see what's happening in inflation. We got to see what's happening in terms of the labor market, and really where the balance of risks to achieving our goals.
Well, I was going to ask you that. What is the balance of risk? Are you more worried about the inflation side or the employment side of the mandate?
Well, I think those are moving closer to back into balance in a way, if you will. We definitely saw inflation very high earlier. That was the primary goal, is to get inflation down. We've now seen the labor market cooling gradually cooling over the past year. So we want to keep we don't want the labor market to weaken too much, but we also want to make sure that we keep the economy in good balance so that inflation comes back to 2%. So I think that those are getting closer to balance, but we're going to have to just watch the data and be driven by that.
So, I mean, you could respond that if they're in balance, why change rates at all?
Well, because I do think we have a modestly restrictive stance of policy.
Okay.
We are putting downward pressure on a little bit of downward pressure on the economy and on inflation, which is appropriate. The question is, do you need to have the amount of restriction in terms of policy in it, or can it be somewhat less? And I think we just have to do our very best to adjust policy over time to make sure we achieve our maximum employment and price stability goals.
I smiled before when you said getting interest rates back to normal, because that's like your life's work.
Yes.
Figure out what normal is. So let's talk about that a little bit. You have this formula that I look at, I don't know, not every day, but every week, because it doesn't move that much, but suggests that the real or inflation-adjusted funds rate should be 0.7%, which add inflation to it, at your target, it's 2.7, which means you're like 160 basis points restrictive, or you add the current inflation rate of 3%, and you're 50 basis points restrictive. Tell us how you think about that. Is my math too simple for your complicated formula?
Well, I think your math is right. It is. The world's more complicated than that. But I think that the point you're making is, at least from my point of view, if you think the neutral rate is somewhere around 1% or a little bit below, we are still in a restrictive stance in monetary policy. And as inflation comes back down to 2%, we're going to need to get interest rates lower than they currently are. That's how I feel about the longer run. In the shorter run, I think that's more of it's the longer run R-star kind of thing. It's telling you kind of where you're going to, where your destination is. In terms of the shorter run, it's all about all of the different data, the totality of the data, and the balance of risks to achieving our goals.
So is the idea, John, that you could take a couple points or a couple quarter points off the top and you'd still be exerting downward pressure on inflation, still be restrictive, or at least closer to neutral?
I think that's my personal view, that we are modestly restrictive. So you could take reduce interest rates and still be somewhat restrictive going forward. But again, we're going to have to figure out exactly what's happening in the economy. There's a lot of uncertainty about all of these things, so we just have to be driven by.
We just put up a thing there, John. It's just an 84% probability for a cut in September. But I notice you've been dancing around giving me a date. The old joke in economics is give them a number, give them a date, but don't give them both. Is September on the table for you?
Well, I definitely think that every meeting is, from my perspective, live. Again, we're getting the risks are more in balance, and we have to just see how the data play out. I'm pretty optimistic about where the economy is. I think we're in a pretty good place in terms of keeping unemployment pretty low, in the low 4s, and having inflation come back down to 2% over the next 2 years. But we can get surprised, and we need to be driven by what's the totality of the data and the risks.
John Williams, New York Fed President, thank you for joining us here.
Great, thanks, Zach.
And great to be here. Guys, back to you at NASDAQ.